Welcome to the Explainer. Today, we are cutting straight through the noise and diving right into the absolute core mechanics of money. Now, for those of us who regularly track markets and capital flow, a lot of these concepts aren't entirely foreign. But honestly, taking a really clinical look at how capital is actually structured, deployed, and multiplied, well, that's exactly what separates standard earning from actual generational wealth building. By the end of this explainer, we're going to completely deconstruct the exact frameworks that govern financial velocity. Let's get right into it. So we have to start with the ultimate question, right? Why do some people seem to just effortlessly get richer, while others are constantly struggling financially? Well, it's not a mystery, and it's rarely just about putting in more hours at the office. It's fundamentally about a structural disparity in how different classes leverage their capital. The real shift happens when we stop looking at our income as the finish line and start looking at how that income is actually positioned to grow. And this brings us to one of my absolute favorite concepts, the stark contrast between working hard for money versus making your money work for you. Listen, most people are locked in this endless cycle of exchanging their time for a fixed, active income. But the real paradigm shift, that occurs when you transition from simply earning a paycheck to mastering capital allocation. Basically, getting your assets to generate yield completely independent of your labor. To break all of this down for you, we'll be moving through 4 specific areas today: the reality of money, the invisible economic forces, how wealth actually grows, and finally, your most valuable asset.
All right, let's jump right into Chapter 1, the reality of money.
Think about it like this. At its core, fiat currency doesn't actually have any real intrinsic utility. It operates entirely on societal trust and institutional backing. Literally, the value of every single dollar in your account is just dictated by our collective confidence in it. When we finally understand that money is essentially just a highly liquid social contract, we realize that wealth isn't really about hoarding the currency itself. It's about leveraging its power to acquire actual, productive assets.
Let's look at a totally relatable baseline scenario. Imagine you go out and earn your first $1,000. That top-line gross figure is what most of us naturally focus on. But the reality of wealth building begins with your net yield. That massive discrepancy between the $1,000 you generated and what actually lands in your bank account, that's the very first friction point in capital accumulation.
And that friction, of course, is taxation. Now, while taxes are absolutely necessary to fund our roads, schools, hospitals, and public services, they also represent the single largest drag on your active income. So the strategic takeaway here isn't just to acknowledge taxation, but to actively optimize for your after-tax income. Structuring your earnings and your investments to minimize that tax liability is a massive primary lever in accelerating your true wealth. Okay, so you finally capture that net income, and what's the default move? We usually just toss it into a standard deposit account, right? But here is the secret of how banks actually operate. They aren't just locking your money in a vault. Banks are highly efficient capital allocators operating on fractional reserve lending. They take your liquidity, pay you a tiny little yield, and then lend it right back out at a huge premium. They are literally leveraging your capital to capture the spread. To build real wealth, you've got to adopt this exact same principle, deploying your own capital to capture the spread, rather than letting institutions do it with your money.
Moving right along to Chapter 2, the invisible economic forces.
The single most pervasive force silently eroding your capital is inflation. It's basically a silent, compounding tax on static liquidity. If you're just holding cash, you are effectively guaranteeing a negative real return over time because of the steady, gradual loss of purchasing power. The financial imperative here isn't just to save your money. Saving alone isn't enough. You have to deploy your capital into assets that consistently outpace that baseline inflation rate.
Then we have recessions. You hear the word and it sounds scary, right? Economies slow down, spending tightens, jobs get scarce. But while they are definitely disruptive, recessions are completely normal, cyclical events in any modern economy. In fact, for the people who are financially prepared, who manage risk, and keep some dry powder on hand, these market downturns often present the absolute best opportunities for acquiring amazing assets at a massive discount.
Another critically important force behind the scenes is your credit score. Think of this conceptually as your institutional, financial reputation. It directly dictates your cost of capital. A strong credit profile unlocks access to cheap, highly leveraged debt, which is one of the main tools wealthy people use to scale real estate and business acquisitions. On the flip side, poor credit doesn't just mean getting rejected, it means any capital you do get access to comes at a prohibitively high, painful premium.
All right, Chapter 3, How Wealth Actually Grows. This is where we go on the offensive. The fundamental mechanism of wealth growth all comes down to interest. And interest is a crazy double-edged sword. When you borrow money for consumption, interest acts as this compounding liability that just drains your future cash flow. It's your worst enemy. But when you invest money, interest totally flips from a liability to an asset. It becomes your best friend, driving exponential growth. Mastering this balance, minimizing consumer debt while maximizing asset yields, is literally the foundation of financial velocity.
Let's make this super concrete. I want you to imagine taking just $100 right now, just a small baseline investment, planting a financial seed today to see how this compounding effect actually scales.
Here is what investors often call the eighth wonder of the world: compound growth. The mechanics are beautiful. In the first year, your $100 generates a yield. But by the second and third years, you aren't just earning profit on your original principal anymore, you're actually generating yield on your accumulated yields. This recursive loop creates exponential rather than linear growth. It turns relatively small amounts of initial capital into massive wealth over long time horizons. But to actually capture this compounding effect, you have to deploy your capital into productive vehicles. What does that look like in practice? Well, the big ones are equities or stocks, commercial and residential real estate, and direct business ownership. These are the primary asset classes that generate passive yield and appreciate over time. By acquiring these kinds of assets, you are effectively decoupling your earning potential from your labor hours. You're growing wealth while you sleep. Which brings us to our final chapter, Chapter 4, your most valuable asset. You might think your most valuable resource is cash, but it's actually time. Time is vastly greater than money. While capital is obviously crucial, time is the ultimate multiplier in the compounding equation. The earlier you deploy your capital, the more aggressive that exponential growth curve becomes later on. Starting your financial habits early provides this unassailable mathematical advantage that no amount of pure cash injection can easily replicate.
There's this incredibly powerful quote from the sources we analyze that just hits the nail on the head. You can lose money and earn it back. You cannot get back lost years. It's so true. Capital can be destroyed, reallocated, and regenerated through new ventures. But the compounding potential of a lost decade, that is entirely irretrievable. The efficiency of your wealth-building strategy is strictly bound by the amount of time you give it to operate. So, as we wrap up this explainer, the big question I want to leave you with is this: how will you make your money work for you starting today? True financial literacy isn't about hoarding cash in a mattress. It's about treating your capital like a tool to engineer freedom and leverage. I highly encourage you to implement these strategies, optimize your capital allocation, and hey, consider sharing this explainer with someone else who's building their own portfolio. Thanks so much for joining me today.